interesting piece. We get this question all the time of like, trend trading or, fading the gap, going with the gap. We're going to kind of put context.
Fill in the gap.
Fill in the gap. There's lots of things you can do with the gap. So do overnight gaps predict the days or the day ahead, I should say. We're going to be taking a look at this in relation to SPY because SPY has the gaps, futures trade. So there's not, it's rare that you have a big gap in the futures. It has to be on like kind of an over the weekend, a move that happens over the weekend, not really during the week. So getting into the first slide here. So, you know that feeling, of course. You wake up, you check the platform, you see E-minis are up 20. You think we're going to be up 40 again. We're gonna take context around these moves, around like either buying into those big moves lower, selling into those big move higher, or kind of following the trend. So the overnight moves, we're going to be looking at how to trade those. So we dug into SPY. We looked at 2017 through today, and then we also looked at 2025 specifically and how the market behaves based on moves in SPY, and we bucketed them into specific size moves, and then we are going to look at the IV rank of SPY at that time to see if there's an indication there. So the goal here is to see if the gaps keep running or if there's, a buy the room or sell the news type event. We're going to kind of put some context to that in relation to 2017 to now, as well as just in 2025. So you got two data sets here that we're going to look at. What do you think is going to be more prevalent? Is it gap higher, continue higher, or gap higher, go lower?
I have to pick one.
You don't have to. You don't have to do
it. Is it a trick question?
No, it's not a trick question. No.
I would say just because we're at market highs, that gapping higher and going higher would be the one that I would pick at this moment. If we were in a different place in time, my answer would be completely different.
Just like anything in trend trading, you have to isolate something more specific to build a case for it, right? So like not all of these are the same. A 0.5%, a 1%, a 1.5%, a 2 or greater percent move in either direction. They're all different data sets. You can't bucket them all into one. And that's why it's so hard, that all these trend type things are so hard to quantify.
Yep.
So let's get to the study here. So we're looking at SPY 2017 to 2025. We bucketed the data sets based on the size of the gap in the overnight move. And this is, we say gap, but the futures are trading. So there's no SPY has to adjust to whatever the overnight move is in the ES futures. It's not like it didn't trade. It trades, but via the futures. And so we're going to look at all the size of these gaps. And then we're going to look at the implied volatility. So we're talking about low, and this is in the context of IV rank, because SPY volatility will never be zero. Or at least I hope not. That would be a weird situation.
Horrible way to make a living.
Yeah, we've seen, what was the lowest? When the VIX was like
8-9.
That was, the VIX, 30-day implied volatility. It was like 8 or 9.
Yeah, it's horrible.
Yeah, and then we had
question life's decisions.
Apocalypse.
I could have been a dentist.
Yeah.
It's horrible.
That's true. It was easy though. You just buy them and then they go up 5 points every single day.
That was the move, $5.
It was 5 points.
That was the move in E-mini S&P top to bottom.
Remember you used to get like a 10-cent tick in the VIX and that would be high implied volatility.
High implied volatility.
We got
them.
Look at this fall.
Right where we want.
This is huge. So we're going to bucket this into IVR. We're going to talk about low, 0 to 15, mid being 15 to 30, high being 30 to 60, and then extreme, we're going to say 60 plus. So we computed the following according to the overnight move in the IV buckets. Calculating the overnight gap, we used, we're going to be looking at the next day move after the open. So today's gap was like, 1/3%. We're looking at what that would equate to the move tomorrow. We're going to quantify the probabilities of closing up the next day, and then we compare the long-term and short-term results. So we're going to look at the 8-year study versus what we've experienced thus far this year. Any questions?
No questions.
Okay, great.
No question, but I like the new bubbles.
I know these are the stepping the game up. We got sound effects. We got,
Bubbles.
great visuals now. So here's just like there we go. There we go. So here's how we quantified the gaps. So we basically just took at today's open minus yesterday's close. So that's your move, and we divide that by yesterday's close. That'll get you your percent. I mean, this is just a percentage of the indices. It's pretty self-explanatory. And then we bucketed all those. The second step was tracking what happened after the open. So we're looking at the move during the session, and then we're going to look at the next day as well. Pretty self-explanatory. And then for the implied volatility, we did it as an IV regime. So we talk about low, medium, high, and then kind of the extreme volatility of 60 plus IV ranks in SPY. And then we looked at the next day returns as well as the probabilities of them being up after such a move.
Okey-dokey.
So the next slide here. So these tables track the SPY's behavior after overnight gaps, and we're looking at 2017 to 2025, split by volatility levels. The left shows the average next day return, and then the right shows the odds of closing higher. So we're looking at both returns and just the overall the odds of the market being higher the next day after all of these gaps, downside and upside gaps. Many of the NAN, do you know what NAN stands for? Do you need to phone a friend?
Can I phone a friend?
Yeah. It's not a number. So those I know. So you get it on like a calculator if you
I never would have gotten that.
divide by 0. So it's those entries are just there is no data set for those.
I was actually going with not a natural was what I was going to.
You're kind of close.
Yeah.
Kind of close
I was trying to figure out how that made sense.
And basically you get some of those results because you're not there's only so many times where IV rank was above 60 on SPY. And you only get a handful of those, and we haven't had those. So you can see here, when you're looking at like our downside 2% gaps, they mostly happen when volatility is high. That's not a shock. And on the upside, again, you're seeing that when volatility is high because you're getting these bigger moves. Most of the time, you're inside that 2% move to either direction, which is what is projected in the VIX from where we are now. So like that is normal, so to speak. I mean, obviously in the moment, it feels like it's
not as normal.
And not as normal. You get the 2% down move and it feels, like things are crashing. But you can see like a lot of these continue, right? So you have the downside move. A lot of times you see the next day return is also to the downside when you're in that higher volatility regime. When you're in the lower vol regime, it's a lot of times it's a buy the dip event or at least a non-event for the next day. You can see both the next day moves when you have these inside moves. I'm ignoring the tails because those tails are much rarer occurrences.
Sure.
We're talking about when volatility is
natural.
Yeah, which is natural. When you're talking about when volatility is low, it usually gets bought up. Those downside moves. On the upside, it's a little bit lesser of a negative correlation there. It's kind of a little bit spotty there. You can see on the will the next day close higher, you have a high, the trend does continue when you have these big moves to the upside the next day. You have a 50 or 44% chance of it moving up the next day. But that's in high, when you have high implied volatility, it's gonna be much more wide of a distribution. When you have low implied volatility, it tends to move, it tends to be a buy the dip is what it's saying.
Buy the dip. Well, we're at all-time highs. Makes sense.
Yes. But this was 2017 to 2025. So according to the research, the golden zone is in that moderate volatility range, which is what we talk about. I mean, when we want volatility to be high, but we want it to be moving, up and down, right? You want vol to come up, comes
Sure.
down. We want to be in that
nirvana. That's the same thing we want with price in the stocks too. I mean, they can continue higher But we want an up and down kind of thing.
Up and down, and you want volatility to change. When you get super high implied volatility, you have these big moves. So 1% to 2% gaps up continue 70% of the time with positive returns, and down gaps often bounce back. It's not a shock when volatility is not getting bid. You're usually seeing a lift in markets. It's intuitive. This is where gap trading still works, while in calm markets, small gaps generally continue, but gaps up 0% to 2% average small gains and close higher around 55% of the time. So again, it's kind of spotty when you're in super low implied volatility and super high implied volatility. The middle range is kind of what we want. So high volatility, when we talk about IV 30 to 60, is a reversal machine. So almost every gap type shows negative expected returns. And the trap here is that chasing those big moves when you have higher implied volatility, that's kind of that's where you get caught, is when you have big moves to either direction and really high implied volatility, you have a propensity to see two-sided action that should be intuitive as well. High volatility tells you that things are going to swing around. And so, the big thing here is to check for implied volatility. You want to see what's happening with implied volatility on these moves. If you have super high implied volatility, maybe you fade that move. If you have lower implied volatility, maybe it continues in that direction in the last 8 years. So getting on to the next slide here. So now we're going to look at 2025 specifically. So this year's data tells an interesting story compared to the last 8-year average. There's a lot of non-results here because we haven't really had low implied volatility for most this year. You had April, which is a huge pop in volatility. And then volatility has stayed relatively bid throughout the year, just despite the last month or so where it really got crushed here. So we've been concentrated in that moderate to high implied volatility regime with some surprising shifts in the behavior. So a lot of these, pretty much all the moves have been kind of a fade, right? So when you look at these moves, like when you look at the higher implied volatility in terms of closing the next day higher, you've really kind of continued with the trends. So you have the 2% down move or the 1% down move, the 1% down move being kind of the buy the dip, the 1% up move or the 1% 1% to 2% up moves have been in the higher implied volatility, have really been a sell event. Like It's kind of been selling into those big moves higher, buying into like kind of the moderate moves lower.
And you have volatility higher, options are higher. It makes a win-win situation. A few and far in between with this market that we've had. Which, by the way, cancel crash here is the S&P's up.
Yeah, we're up 12. It's moderate volatility.
Moderate volatility. You're right.
Next slide here, getting to slide 7 here. So moderate volatility, we're talking about the 15 to 30 range, remains tradable but selective. 1% to 2% gap up still have a high win rate. So you're talking about 71%. And the down gaps bounce aggressively. And this is because of the moderate to higher implied volatility. When it's lower implied volatility, which we haven't really had this year, it's a different story. So high volatility has become extremely bipolar. Look at this. Bipolar. I like that. Small down gaps are producing massive bounces. I mean, that's kind of where the buy the dip comes in, averaging a plus 3.87% return with 67% closing higher. And I take that with a grain of salt because we're looking at just 1 year, but a lot of the volatility that we've seen has been very, very headline news driven. It's been less about kind of the underlying stocks themselves. To talk about a AMD type move where it's up $60, those have been kind of rare generally. But any gap higher in high volatility has been kind of a fading move. So if you have big moves with big implied volatility, you typically take the other side. That has kind of been the what has worked this year. So in moderate IV, stick with the classics. You buy small dips, and then you play for kind of the continuation in these bigger moves if volatility remains low.
Good job out of them. But you got more to go with a takeaway here.
Yeah, one more slide for the takeaways. So overnight gaps matter, but the volatility changes everything. So you have to look at implied volatility. You can't just expect things to continue just because they have that big move. Moderate volatility is still the best zone. And we talk about this all the time of like, you don't want super high implied volatility, even when you're trading in like single name equities, like your Oklos and your Rigettis. Those, they look really juicy, but there's a lot of risk in those. And so you don't want those super, super high implied volatilities. And if you are trading those, you stay small. You don't want the super low stuff because you're not getting paid to take the risk. You want it somewhere in the middle. And that's what all of our studies come down to. So the bottom line is that we're always looking at implied volatility. A big move in low volatility acts nothing like a big move in high volatility. When you have high volatility, you should expect wider distributions, which is what we see in the data here.
If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.